Hello everybody. So in this slide I have an overall overview of my portfolio where I have the highest stocks that I described yesterday in part 1 of this video, which would be Tesla and Enphase for me. And the bulk of my stocks are actually my high conviction stocks, but not highest conviction. They are just high conviction, hyper growth stocks. Now I'll explain why in a minute. And then the rest of the stocks, very little of my portfolio is in these more binary stocks. This is an ETF, of course, ARK Invest, but this is more binary payouts where the growth is more way out in the future and where it's less predictable. So I handle this part of my portfolio more like a venture capitalist would handle their stock. And quickly, if you haven't seen the first video, it's important to note that the growth stock portfolio, i.e. this three-tier portfolio, that's just about a third of what I aim, the assets in general to be, or where I view my asset planning to be. My asset planning also includes bond alternatives, which is Bitcoin, and a lot of savings account stock. Like, for example, Google would be a good savings account type stock. So that's the other third, bond alternatives. And then the last third is real estate with some leverage. And I made a whole video series about the three main asset classes that I consider to be important in asset planning, essentially. But today, in today's video, I'm focusing on the characteristics of my 65 to 70% of the portfolio, which are most of the stocks that I cover on the channel fit into this portfolio, into this side of the portfolio. So let me get started. I call these high conviction stocks, 65 to 70%. And you may ask, what is the difference between high and highest conviction? Well, what I will say is that all of my tier 2 stocks that are tier 2 to me could be tier 1 for someone else, because I believe that for you to own a stock through thick and thin, for you to hold a stock no matter what, you only need to have the highest conviction. And the highest conviction is really, really tough to get. You can't be 100% sure, but you need to be like 95-ish% sure. You need to have your highest conviction. And I believe that your highest conviction can only be due to personal truths, or things that you have experienced, things you have seen, things that you know to be true. That's the only type of conviction that's going to help you hold through the toughest time. So in part 1, I explain why Tesla and Enphase are my personal truths type of stock. Why do I buy Tesla? I've been driving a car, not a Tesla, but I've been driving a car for 17 years. I've driven many Teslas. Whenever I go rental, I try to get a Tesla. Unfortunately, I have a gas car that's more recent, so I haven't been getting a Tesla, unfortunately. But I've worked at a dealership before. I'm very passionate about everything that had to do with PayPal Mafia and the PayPal entrepreneurs that are, referred to colloquially as the PayPal Mafia, which is Elon Musk and Peter Thiel. I'm very familiar with the 0 to 1 book. I understand all of these things. I believe I understand them. And so that gives me conviction to hold Tesla no matter what. And I also understand debt. And I get that, the competitors, I explained in the last video, the competitors have $1.1 trillion of debt. So I don't know if they're going to do it. I don't know if they're going to compete when you have so much debt. So there's things that I understand about Tesla that make me so confident about being a highest conviction. And these are things that are due to my personal experience. Same for Enphase. I worked for a solar installer in Europe when Europe was putting a bunch of subsidies, just like the US is putting subsidies now. I've seen firsthand the effect of subsidies on solar. I've been very interested in solar for more than 10 years, actually. So these stocks are part of me. That's why I have very, very high conviction. And they also have true fundamental analysis that would put them at least as a tier 2. But let me give you another example, which is in our video, is Nvidia, for example, also has the hallmark of a tier 2 and could be a tier 1 for someone else, right? But I'm not a gamer, right? So I haven't experienced the product. I don't work in data center. I don't work in that type of industry. So I haven't seen my boss order $300,000 worth of A100 GPUs that fit in a little box. I haven't seen that, right? I've never waited in line at Macro Center to get the latest GPU and spend $1,500 on it. So I don't have the personal experience that would allow me to hold NVIDIA no matter what. And the point that I'm trying to make here is that depending on your personal experience, what I view as high conviction, and the stocks I cover in my channel, I always view as high conviction. What I view as high conviction, that could be a tier 1 for you. And my tier 1s, could be tier 2 for you, or they could even be, they could even be outside of your portfolio because you have no confidence, no experience. Like they could even be outside of your portfolio, right? It's all about personal confidence in the investments. That's the idea of a conviction weighting, and based on your own conviction, your portfolio will differ. But conviction is necessary to hold the stock no matter what, and this is why I only have 2 stocks that I don't think I will sell, which are Tesla and Enphase, right? These, if there's issues, I will sell and I will act fast. So let me go into some of the other reasons. So hallmark number 1 is that my high conviction stocks, I could easily see be tier 1 for someone else who has that personal experience. Second thing, I want to talk about diversification. And before, let me do a little preface to diversification. Some say that diversification is for idiots. If you go on YouTube a lot, you may have seen these videos, or you shouldn't diversify, you should go all in. Mark Cuban is actually famous for saying that. A lot of people say diversification for idiots. And so some people may say that I might want to go all in on my highest conviction number 1 or number 2. And this point is well understood. Like I understand this point. But I'm not 100% certain of anything. If there's, God forbid, but if there's a war out there or something, like I'm not 100% certain in anything. Therefore, I can't go 100% into something because I'm not 100% certain in anything. So that's my response to that thing. Is like, why would you even bother buying any other stock? And you see this a lot. You see a lot of people, it's like they just buy Tesla, and it's like, why would you bother not buying anything else but Tesla? No, that's not how I do things. I look at diversification, and because I believe to have relatively more ignorance on these stocks, which I have spent a lot of time researching, but I believe that there is things that I don't know about these stocks, and so that is the reason why I diversify. I diversify against my own ignorance. Diversifying is against your own ignorance. And so let me give you some examples of that. And none of these examples would apply to my ownership of Tesla or Enphase, but it would apply to all of those for me. So for example, it could be a product I have never used. I've never used Snowflake, CrowdStrike, Datadog, Palantir, Nubank. I've never used these products. So maybe if I use them, I would have insider knowledge. I would have something that I know that would prevent me from investing. So I'm protecting from my own ignorance of not having used the product. Let's talk about country of origin. Let's say, I follow quite a few Brazilian stocks. I've never been to Brazil. I don't know anything about the Brazilian market. I don't know Brazilian politics very, very much. So it's an added risk for me, right? So by owning multiple stocks, I diversify away against the things I don't know in Brazil, right? The same is true for C Limited, for example. I don't know the Indonesian market. Okay. What's the third one? So industry specifics, being an industry outsider. When you're an industry insider, there are things that you can only learn through experience. That's the whole nature of tacit knowledge. And so, for example, Palantir has a lot of success with their Gotham product, which is their military product. I can't assess that. I've never used the product. I've never been in the military, right? Same for selling software. There's a lot of things, a lot of software stocks I follow are sold in different manners, and I have never sold software, so I do not know whether Palantir's top-down approach to software sale is relevant compared to Snowflake. I have a feeling Snowflake's bottom-up sell is a better approach, but I haven't been an insider of that sales process. Same for investing in the medical field, right? Teladoc, for example, one of the stocks that I believed in, seems to really have issues growing. And so I don't know the medical fields, I don't know the regulations. And so obviously, I'm going to have some more risk that I need to protect against. These risks not being as true for a company like Tesla or for a company like Enphase. In the example of Tesla, for example, I know cars. I see them every day. I've been to dealership. I've had the unfortunate experience of buying multiple cars at dealerships. I've worked at dealerships. Anyways, there's a bunch of things that I know about cars that I really don't know about this. And right, in the case of Tesla, I live in the US. I see it. It's an American company. Okay, moving on. So we understand diversification is important. Okay, what's another hallmark of this tier 2 strategy? The whole idea of pairs and looking at opportunity across pairs, or really a better way to do it would be across peers, as I would say, because oftentimes you could have 3 or 4 stocks that kind of fit in the same category, same valuation, kind of the same type of stocks. And so you can take advantage of arbitrage opportunity if one stock is really overhyped, overbought, and another stock has been ignored by the market. You can kind of take advantage of these opportunities. And why would I do that on these stocks? Well, because of the risks I just outlined here. I can't have peak conviction because of the risk I just outlined. So since I can't have peak conviction, it makes no sense for me to hold them no matter what. And in contrast, my peak conviction stocks, my highest conviction, for example, when Tesla crashed, I slept very well at night. In fact, I was in vacation. I was just buying the stock. I didn't even flinch. Like it was nothing because I have full confidence in the stock. If that were to happen to any of these other stocks, well, I would be all hands on deck, studying what's happening and strongly considering whether I should sell or not. So, for example, here are some of the movements that I make between those pairs. So recently, I have sold Teladoc into HIMS, and I'm slowly selling it, and we'll see why I slowly sell it. And I never do stock moves. I'm slowly selling Doc into HIMS. Why? Because of bad execution. I don't think Teladoc has been doing too well, and I think HIMS is doing wonderful right now. So I've been slowly selling one stock in one industry into another stock in another industry. All right, what's another one? Nvidia. I'm almost out of my Nvidia position due to, I believe, overvaluation. I think the stock right now is overvalued. So you can take my example in my other video when I talk about, if you are very much an insider of a GPU market and you know GPUs, you're never going to sell Nvidia because you probably understand the product much better than I ever will, and you use the product every day. Right? But to me, I'm selling it because I find it a little expensive right now. And so I've been putting more money into, for example, AMD, which would be kind of a peer stock, even though they're not GPU oriented. I've been putting into AMD because I think AMD is a much better value right now. And I've also done, and this was like a few months ago, but I've also sold some Palantir a few months ago and converted it to Snowflake because I believe Snowflake is executing a little better, and it's kind of Snowflake's moment to shine right now. And Palantir, they need to start shining. And anyways, moving on. So it's kind of what I do. So I look at pairs, I look at peers, and I try to see if there is some alpha generation. And we'll see in the end why this may be just an illusion, but a useful illusion. So what you would do is you would follow stocks in similar industry. If you look at my most undervalued stock video, that's essentially what I do. So, you would put SOFI and Nubank, and you would look at how they compare in valuation, C Limited and MercadoLibre, Snowflake, MongoDB, Palantir, Datadog, all kind of related to the data analysis space, and you would look at that. And also, my weekly valuations would kind of dictate my buys for the week, or my movements for the week. Keep in mind, I am not retired, right? So I'm still in my earning career, and so it's not like you're in the consumption phase of your portfolio. I'm still adding to the portfolio, and so this helps me decide which stock I want to add and which stock I don't want to add to. And this allows you really to judge stocks against peers, because it would make very little sense to compare, say, a high-growth software stock to a payments stock in Brazil, or a high growth software stocks to a bank in America. Like, it makes very little sense. So you gotta compare across peers. Valuation holds and differs across industries. So I think that's an important point here. And moving on to point number 4 here, which is, why do I trade, or why do I make shifts within the portfolio? And I do this mostly to protect myself. And some say it's you shouldn't do that. Some say you shouldn't trade between positions, and it's important to do nothing and wait. But investing is just as much knowing yourself as kind of knowing the best ways to go, but you also need to know yourself. And I'm comfortable to do nothing and wait with my highest conviction positions. Like Tesla, I'm comfortable doing that, perfectly comfortable. In fact, in IRAs, I will typically go with a stock like that. Like Roth IRAs, $6,000, boom, all Tesla. And that makes sense because it's kind of like I'm not going to follow it because I have the highest conviction. But for when it comes to trading, right, you have very, very prominent, more value investors who may perhaps not follow the world of technology as much and the world of change as much, who will say, don't trade, you can't trade. And actually, Ben Graham, they take a lot of their philosophy from Ben Graham, the Intelligent Investor, famed book. And one of the main takeaways that I have, well, there's many, but one of the things that I found more relevant in Ben Graham is when he talks about protecting the investor for himself. The investor is his first enemy, and the whole idea that you shouldn't trade. And so I have thoughts about this. One of them, first of all, is the whole idea of fees, right? Fees were very, very high back in the day. And I remember when I started, it was $7.99 a trade. Okay, today fees are near zero. And with fees being near zero, that means there's new forms of investing that you can do without having a portfolio that pretty much just exists to pay fees, thanks to trading fees being near zero today. So that's one aspect that I want to emphasize. And so you almost have to wonder if index funds would have worked as well if there were no trading fees when they were first introduced, which is also, I think, an interesting thought here. But another one is trimming, and that's what I call it. Trimming a stock, in my view, is not trading a stock. So what I'll do when I trim a stock is I'll take, say, 5% of the top, sometimes even less, sometimes like 3%. I'll take just 5% of the top of a position that I find is getting overvalued or that I'm getting uneasy about for a reason or another, and I'll move it somewhere else. And so at this rate, it would take you 1 month to get out of a stock. So you can see, and of course, if there was like a sudden death event, like I obviously wouldn't do it like that, but that hasn't happened to me, to any of my companies, so I'm lucky, I guess. But otherwise, you can see how over a month you're protecting from yourself because you're not doing anything stock. You're not doing anything crazy, right? If a stock crashes after bad results and I decide to exit 5% at a time, slowly, the stock has time to recover as I slowly exit. There is way less risk when you do, when you tinker with a portfolio, when you do small moves, there is less risk. So that's why I protect from myself. And Ben Graham says one of the main dangers of investing is when the investor has an urge to do something, and that's why they say you should be patient and do nothing. And so tinkering, and that's why I put the kind of a definition of tinkering here. Tinkering is my definition of what I do. I am passionate about stocks, and I have that urge to tweak my portfolio often. I often have that urge. And if you look at tinkering, tinkering is a technique more to manage your hobby. It's an attempt to improve something in a casual way, right? Often to no useful effect. And that doesn't mean it's always not useful, but you do it more casually. You play around the portfolio, you fiddle with the portfolio. You do it very, very, very tiny. You don't go bold, and so at worst it has no useful effect. And at best, you're protecting yourself from, imagine you haven't traded in a year, and you hear on the news that there is, I don't know, a problem somewhere and stocks crash 9%, it's easy for you because you're not used to that, weekly trading. It's easy for you to go bold and just log into the account and sell everything. It's an easy mistake to do. I'm protecting myself by having this habit of just tinkering with it, right? Because anyways, it's just what works for me. It may not work for a lot of people, but it is what works for me. And so tinkering with the portfolio may mean, I trim 5%, say, to, I don't know, Nvidia, because I find Nvidia too highly valued. I trim 5% of it, and maybe sometimes I just take 1% and add it to 5 over tiny positions. It's not like it looks as a waste of time to anybody who's not passionate about stocks. That's what it does. Just like tinkering with a car would look as a waste of time to anybody who's not passionate about cars. But if you're passionate, it gives you something to do. And if you do something, you're not going to make these stock movements that can really, really, really hurt a portfolio. You're going to take a long time to make your decisions. And also, it's enjoyable. It's enjoyable for me, So I believe this has a little risk. I've been doing it for a long while. It has a little risk. I used to do it way less when we paid $7.99, but today it's just so easy to have smaller positions and change them often. And it gives me something to do, and it may generate some alpha. And if you follow Kathy Wood and ARK Invest, you know that she does that. Like sometimes she'll trim a stock like 0.7, 0.5%. You know that she does that. It may generate some alpha to do that. And either way, that's kind of a hobby part, and it doesn't hurt the long-term returns too much, in my view, in my experience, actually, not in my view, in my experience. So anyways, this was not investment advice. I hope this helps you understand how I deal with my tier 2 stocks in the portfolio. This is just entertainment. Appreciate your likes, appreciate your subscribes. Thank you, and have a wonderful day.